Yeah, good day to everyone. Anywhere you might be that you are listening to me. We are kickstarting our ICANN FR refresher course um, from this session, and today we will be starting with the regulatory and the conceptual framework. And when we talk of regulatory framework, what we are talking about are the basic principle, the basic principles, basic principles, laws, etc., assumptions, policies, controls that are put in place by a regulatory body, by a regulatory body, laws put in place by a regulatory body, in place a regulatory, by a regulatory, by a regulatory body, you know, and to promote what we call to promote fairness, fairness and clear objectivity, clear objectivity, objectivity items, of items reported, reported in the financial statement, reported in the financial statement. So, um, those laws that are put in place, the rules, the the policies, accepted assumptions, various controls that are put in place, you know, by a regulatory body to promote the fairness and objectivity, a clear objectivity of items reported in a financial statement. They are what we call the regulatory framework. So, uh, the regulatory body for accountants world over is known as the International Financial Regulatory Board, IFRS, RSB, Regulatory Standard Board. So they're the one in charge. We'll still look at those bodies and their functions and what they do at later on in this session. But so those laws and rules and principles that are put in place are known as the regulatory framework. The next thing we need to ask ourselves is, why do we need regulations in accounting? Why do we need regulations in accounting? Number one, for comparability. Where there are no regulations, it means that different companies may just account for similar transactions in different manner, and this definitely, will make it difficult for users of a financial instrument to compare and evaluate financial performance as well as financial position of different companies. So what we're saying is this: where company A prepare a similar transaction in different way, we can't compare with that of company B. But if we have a common ground, a common law, a common principle that guides us, it means that we can easily compare company A, company B, that are different, the same sizes and the same status. Another reasons why we need a regulatory framework for accountant or for accounting, as it were, is for transparency. Transparency. That is, where there are no regulations, manager may deliberately produce, financial information that do not actually reflect the true position or the performance of the entity. And so, but where there are regulations in place, it will be difficult for any manager to do what we call window dressing of items as reported in the financial statement. So, it is important that regulation must be in place for transparency. The next one is for reliability of information. Users of financial statements definitely they will always want to have, what will give them that common trust in informations provided by entities, by companies in their financial statements. So now we must understand that where there are no regulations, users of financial statements may not trust the information that is provided by companies. You know, of course, where there are regulations, it can be verified as to how things should be done, how things have been done, and like that. Another reason is to avoid bias. To avoid bias. That is, financial statement sometimes may be prepared to favor a particular set of people where there are no regulations. You just say a company, because they want to suit some set of persons, they just prepare their financial statement anyhow. A good example is if you want to attract certain set of investor rather, and then you just repackage and remodel your financial statement and to suit such investor. But with regulations in place, it will be difficult for you to manipulate. Those people that you want to manipulate the figures for can easily call on a professional, and they can evaluate what you have prepared and check it with regulatory standards and principles that are applicable, and then they can deduce if you have actually comply with the regulations, as it were. Another reason is quality choice of accounting treatment. Quality choice of accounting treatment. Quality choice of accounting treatment. You see, the truth is regulation of financial reporting will always be needed, you know, because if there are no regulations, the reporting entity of any, you know, of any locality or any location around the world may present their financial statement that contains transaction accounted for based on their own choice of account treatment. That is, they may make choices of any account treatment that suit themselves. But with regulations in place, it will be difficult for any reporting entity to just make any accounting treatment of any kind and then make such uh, treatment. So these managers will be free to choose accounting treatment at any point in time if regulations are in place. So with these five, I mean, you can be asking your exams, what are the reasons, or what are the reasons that why we need the regulations in accounting? You understand? They can ask you and put some 2 3 marks there. These are the core reasons for comparability, to be able to compare companies, reporting entities from one jurisdiction to the other. The second one is transparency. Everything must be transparent, must be fair, must be open. Reliability, for users to be able to depend and trust the information that are presented, it must be reliable. But as you don't present a financial statement to suit some set of persons, but where there are no regulations, this is possible. And then lastly, quality of choice of accounting treatment. So you can't just make choice of any accounting treatment. There is a common ground, a common treatment for every accounting items in the financial statement. So each of the entries have their own treatment. So you don't just do anyhow from there. So the next thing we'll do is the sources of regulation, sources of regulations, sources of regulation. So we can categorize all the sources of regulations of accounting processes into two. The first one is the laws of the land, the laws of the land, laws, that is the company laws. A good example is in Nigeria we have what we call laws. A good example is Kama Company and Allied Matter Act of Nigeria. Kama Company and Allied Matter Act. We also have that one, guys, is the companies as of their operations in Nigeria. For instance, the comma, gives a rule as to how a company should keep its record. They give a rule as to how the record must be kept in their registered offices. They also give a rule as to the form and content of their annual account, what it must look like. Under comma, we have the duties of the directors are spelled out. They have the duty to prepare and to present financial statement. There is also the rule in that comma for determination of profit available for distribution to shareholder as dividend. You also have another rule on issuance of shares, redemption of share capital, and many others. So, laws are source of regulations. When we say regulation, we have defined it as those principles, those assumptions, those laws, those rules that guide how the price of accounting should be for each of the entities. So, sources now we have laws. Example is karma. I've seen a question whether they said you should itemize what karma gave as a regulation. You understand me? That guys, the accounting practice in Nigeria. You understand? So you should be able to tell us that under karma, there is what we call they gave the rulers so the how a company should keep their accounting record. That is important for a company to keep their accounting record. That is number one. Number two, they must keep those records in their registered head office, or designated office, but it must be registered head office. Then they also state that the directors of the company they must prepare and present annual financial statement. And another thing, they gave the rule that the annual financial statement must contain the information of stewardship, how the company has been run over a period of time, usually 1 year, the annual year of reporting. And another thing that they give is they give rule as to how shares should be issued, how shares should be redeemed. They also gave rules as to the type of reserve to be maintained by each of the company. You understand? So they can ask all of this. So just know it as it were. The other sources of regulation of accounting practices is what we know as the standards or accounting standards. It's known as accounting standards. So when we talk of accounting standards, these are guidelines, you know, statement or opinion on how financial transaction events, other accounting information should be accounted for in a financial statement. You know, and these accounting standards, they can be divided into two: international and then the national accounting standards. So every of these ones they really matter a lot for you to know. We will also look at various standards in the course of this refresher. So all of these standards put together, they guide the practice of an accountant. We have various international accounting standards. We have international financial reporting standard, IS, IFRS. They are what guides the way we operate uh, and account for items on the financial statement. So these are the sources of regulations. Sources of regulations. Example of accounting standard is statements of accounting standard issued by Financial Reporting Council of Nigeria. Then we have International Accounting Standard Board. They are the one that issues international international financial regulatory standards. So that is how it is. So that is that for that. We can't talk about standard and not talk about the bodies. So let's look at the bodies that set accounting standards. It's important we look at this. I wanted to skip it before because I believe it's something you will have known. But let's look at it together. Bodies that set accounting standards. That set accounting standards. So we have We have, for instance, we have in Nigeria, we have what we call the Financial Reporting Council of Nigeria. Financial Reporting Reporting Council Reporting Council of Nigeria. And then these ones, they are the one that are in charge of setting what we call the local or the national standard. That is our standard. For instance, in Nigeria, we have what we call the National Accounting Standard, known as a Statement of Accounting Standard (SAS). Hmm? Although we have adopted IFRS fully, but there are still some SAS that are still in use in Nigeria. For instance, under the petroleum, there are some standards that we are still using in Nigeria. Then the second body is the uh, international financial international international financial international financial regulatory reporting board, regulatory board, international international financial so we have the international accounting standard board as against the international financial regulatory board that I wanted to mention earlier. I think that have been repealed. So what we have now is the international accounting standard board. They are the one that are in charge of setting what we call the International Financial Reporting Standards, IFRS, International Financial Reporting Standards. So, you know, they have what we call the Monitoring Board, the Foundation, the Advisory Council, the board itself, as well as the Interpretation Committee. All of these ones, they are there, they have their roles and what they do. And that is that for that. And so very quickly, it is important for us to also look at the next one, which is the conceptual framework. Conceptual framework. We said that the regulatory framework, they are the laws, they are the principles that guide, you know, that guide the uh, reporting of items on the financial statement. So all of these, they are very important for us to know. Whereas now, let's look at the conceptual framework. The conceptual framework, they can be referred to as a general accepted theoretical principle which form the frame of reference for how an accountant, or a reporting entity should guide the way they are doing their reports. So what I'm trying to say is this: a conceptual framework is a system of concepts and principles. They are concepts, they are principles that are utilized or make use of in preparations and presentation of a financial statement. So we can put it in this simple form that conceptual framework is a statement of generally accepted theoretical principle that form the basis for which our financial statements are being reported. So what I'm trying to communicate to you is that while the regulations give the rules, the laws, the basic principles and the likes, the conceptual framework gives the general acceptable theoretical principles, that form the basis for financial reporting. Emphasis is on the theoretical principles. Theoretical principles. They are the one that gives us an overview of what exactly it is that we are to present. You understand me now? So we have the relevance, or what, let's say the importance or the reasons for conceptual framework. The reasons are the same thing as the reasons are the same thing as conceptual cons conceptual conceptual framework. Reasons for conceptual framework. So reasons are the same thing as saying the advantages or the relevance or the importance of having a conceptual framework. Amongst other reasons, we have the following. Amongst other reasons, we have the following. Number one, it strengthens the credibility of financial statements or financial credibility of financial statement mm, reported. It's strengthening the credibility, that is, it makes it much more credible. Number two, it negates inconsistency. It negates inconsistency in practice and application of required it negates inconsistency in practice and application of required accounting principles. It negates inconsistency, as it were. And number three is that it improves the quality of accounting standard. You know, the conceptual framework improves quality the quality of accounting standard. Quality of accounting standard. So that is that for that. And then number three, it assists it assists it assists preparers preparers it assists preparers in apply generally acceptable principles. And number four, the next, it assists the auditor. It assists auditors. It assists auditors to form an opinion. To form an opinion. So form an opinion of conformity to regulatory let's just say acceptable standards. So that is the reason. So we have various other reasons, but let's limit ourselves to these five various other reasons whereby it is important for us to have what we call the conceptual framework. Like I said, the regulatory framework provide the regulations. The conceptual framework provide the concepts of practice. The theoretical concepts of practice. So it is important for you to know the difference between the two. The regulations give the guides the principles, the rules. Let us put that way, the rules that guides how you operate. Why? The conceptual framework gives us the concepts to adopt, the concept to make the most of as we engage in our financial statement reporting. So that is that for that. So let's go to the content and then the scope. Content and scope of conceptual framework. So the content of conceptual framework are divided into are divided into 8 sections. Divided into section. Into 8 sections. The first one is the objective of general purpose general purpose financial reporting. Financial reporting. And then the second one is qualitative characteristic. Qualitative characteristic. Characteristic. Qualitative characteristic of useful financial information. Qualitative characteristic of useful financial information. Then the next one is financial statement and reporting entity. Financial statement and the reporting entity. Then the next one is the elements of financial statements. Then the next one is recognition and the recognition of items in the financial statements. Then next one is measurement. That's the next one. Then the next one after this one is presentation and disclosure. Then lastly, we have the concepts of capital and capital maintenance. Concepts of capital, concept of capital and capital maintenance. So that is that for that. So what we do is let's take each of these section. They call them chapters. You can call them categories. You can call them chapters. We take each of them and give them quality explanation. But that will be in our next session. Thank you for listening. You will soon hear from me. Thank you.